I can't be that mentioned earlier. Yeah, so let's go ahead and welcome Gary Thompson here like the detonator said, my name is Gary Thompson. I'm a retired Air Force Chief, and retired 4 years ago. Started working for USAA. I grew up here in Oklahoma, in Tulsa. I went to East Central High School, and my wife was she's from up near Baldwinsville, so this was a natural place to come back home. So we call Oklahoma home, and it's great to be back here. 4 years I've been coming here to the Cowboy City and come talk to you guys as cadets. And last couple of years, it's kind of focused just on the seniors. But the good thing, how many seniors do we have here? Just the two of you guys. And so most of you guys are freshmen. Freshmen. Okay, so and where's the juniors at? Juniors up in the back. I can't get a whole lot of the juniors. All right. So here's the deal. Okay. You guys don't really know me, and I don't want to spend a whole lot of time on my background to try to tell you who I am or what I did in the Air Force and whatnot. What I'll tell you is that I'm here representing our educational foundation at USAA to talk to you about financial readiness. Because just like physical fitness, just like job readiness, just like mission planning and all those things, financial readiness is an important part of your life. Now, I was an instructor at the First Sergeant Academy, but before that, I was actually a First Sergeant. And I'll tell you that First Sergeant, the doors open and closing on a regular basis, just like it is for the captain, just like it is for the commander. People are coming in, and everybody's got issues, okay? When I say everybody, not everybody, but a lot of people will come into your office. And so what I found, what I learned over my years as a First Sergeant was people would come into my office and say, hey, I got a problem. I need your help. Okay, well, what's your problem? 50% of the time, their problem is what? Yes. Money. My paycheck doesn't go far enough. The captain and I were just talking about it. You got 1.5% raise. I'm not trying to scare you out of the Air Force. It's a great way of life. Okay, but whenever you have small raises, we're going to do the best we can taking care of you. But you guys are going to be stealing on these problems. Okay, people are going to come to you and go, hey, sir, I need some help. Okay, so the other half of the problems, just take a wild guess what those were. Relationships with, marital, my boyfriend or my girlfriend is something going on there or something like that. Okay, so in 50% of the relationship issues, if you really ask enough questions, you can dial it back down to what? Money, okay? So guess what? 75–80% of the problems out there in our Air Force are money. When people can't focus on their job, it's money. When people can't get along with their coworkers, it's money. When people can't focus on the mission, when the mission starts to degrade, guess who pays for that? Who pays for that? The captain, the commander, the major, the lieutenant colonel, or whoever it is that's in charge of that mission. You, whenever you get commissioned, you go out into our Air Force, are going to be paying for that, okay? So that's why we're here to talk to you guys. We've put a lot of energy into our ROTCs, trying to make sure that our ROTCs have a good understanding on the financial readiness. Maybe not something that you need personally. You may have mom, dad, you may have a brother or a cousin that helps out with some of the financial planning. Heck, you may be a finance major, or you may just be savvy on some of this stuff. I'm betting that a lot of you aren't, because we don't get this in high school and in junior high. They don't really talk about this. And really, sadly enough, our Air Force doesn't spend enough time talking about financial readiness in these terms, okay? So that's why our Educational Foundation exists, so we come back here and give you guys some information, all right? So here's the thing. I'm not here to sell any products. I can't even answer any questions on USAA stuff. So if you got questions about USAA, hold those till you see me here in August when I come for your meat run. Cool? Then you can ask me questions about USA. Until then, our mission is to not endorse. Our mission is to not promote any particular product or service. The information that's in front of you is yours free. There's no commitment to the university here. So we're just providing this for you to try to help you out, to try to ready you up, get you ready. If you're a freshman, This gives you a little bit of time to start thinking about your future. If you're a junior, it's time right now to start planning your future. Well, seniors already got the plan. If you don't, you're behind the curve. Make sense? All right. So, here's what we're going to talk about today. Setting some goals, credit, identity theft, because it happens a lot. You guys are about the hard part, all right? Saving and investing, and then risk management or insurance. You guys know who Dave Ramsey is? Yeah. So, okay, so I'm good. A lot of you, and it's not the good guy; it's the financial advice guy, right? Cool. Okay. So, so Dave Ramsey says that 80% of the Americans do not have a financial goal. They don't sit down and think about what they want in the future. They don't sit down and think about when they want something in the future. All they do is they just kind of, wake up each day, get up, put on their monkey suit, they go to work, they come home from work, they take off the monkey suit, they put on some work clothes, go out in the yard, do some work. They don't really think about it. Drink a beer at the end of the day, eat a steak, whatever it is they want to do. But they don't really plan for tomorrow. And you've heard these commercials, feed the pig. I don't know if you guys heard them or not, but feed the pig, okay? In other words, if you don't pay into the pig and save for the future, nobody else is going to do it for you. And guess what? I grew up in an Air Force that actually kept trying to help us out, with retirement and whatnot. I don't know what's going to happen with you guys' retirement plans. But maybe a little bit more incumbent on you to save for your own retirement. So you need to know what you want and when you want it. Oh, by the way, Dave Ramsey also said that 20% that actually do set a goal, that those who set the goal, write it down, and have an accountability partner, have somebody like somebody who's one of your mentors here at the school, or a classmate, or somebody will actually help you, hold you accountable to your goal. Somebody who's going to be in contact with you in the future to say, hey, how do you come in 5 years into your financial plan? How do you come in 10 years in? Somebody, in my case, it's my wife. My wife is my financial partner, and she's my accountability partner. And when we sit down and start talking about stuff, she helps me. She helps gauge my interest. She says, hey, a lot of times she says, hey, we need to sit down and talk about this. All right, so she holds me accountable. Cool. And that's a great partner to have. All right, so one of the reasons why we start on young people, and this is not necessarily focused on you, it is, but in your leadership role, you start on your airmen. So let's say you're a butter bar lieutenant, or you're a captain or something, and you've got people that work for you, and they come to you for advice and whatnot. Don't wait for them to come to you for the advice. Go to them and say, hey, start out young. Because when you start young, you have time on your side. At age 22, you've got 45 years for your investments to work on your behalf. And 45 years, a lot of time. At age 67, you start cashing in on some of those retirement plans and investments. If you wait till you're 32, then you cut that window down. And I have some slides that are going to demonstrate that here in a second. A lot of us have a hard time deciding the difference between what we need and what we want. Okay? And I'm not going to go too far into this, but just tell you that if you can put off some of the things that you want today and just take care of things that you need. I mean, everybody needs safe, dependable transportation. Everybody needs food on the table. Everybody needs a nice, safe place to stay. All right, but some people I kind of need to gauge. You don't need a Dodge Fight. All right. You may want one. You may want an Escalade. You may want something, but it might be more realistic, financially, for you to drive, just an F-150 pickup truck or something, okay, or a Ford Fusion or something. Whoa. All right. Some of you have families that can help you out financially. Some, may have family land in, I don't know, pick the town, Woodward, or up north by Ponca City, near a lake or something. But the majority of us, what you're working for in the Air Force is you're working for your own financial security. I don't sit around going, what's my dad going to leave me whenever he passes away? It's not going to be much, or whatever it is, that's his money. I'm working for my own. But guess what? I am thinking about my son, because when I retire, and eventually one day when I leave this earth, I don't want my wife to have to worry about, how she's going to continue to pay the bills. And I don't want for my son to have to, worry about how he's going to, make it through college and things like that. So if something happens to me, I want to make sure everybody's taken care of. So family involvement, it's a big piece of your financial puzzle. We're assuming that most of you don't have, somebody just taking care of you through life. Risk tolerance. That's basically when you're young, you can afford to take more risks with your, with your investments. And what I mean by that, okay, so I was working in the Pentagon 4 years ago, but 2 years before I retired, 2008, market crashed, right? I worked when I was in the Pentagon, I worked around a whole bunch of civilians. And these civilian guys, they're all standing around with their little, Blackberries out, counting their investments. I mean, they're watching their investments like a hawk because they're, dropping retirement paperwork. I'm gonna retire because I got money out the, So anyway, they're loaded up, okay? And what happened on one day whenever the market went kaput, and it happened overnight, almost overnight. It went from about 12,000 down to about 8,000 overnight. And they come in crying. I mean, I saw grown men crying over their portfolios going, man, I got to pull my retirement paperwork because I can't afford to retire now because everything has gone kaput, all right? So, risk tolerance. As you get a little bit older, you have to dial back the risk on some of those investments. Because if they had some of their long-range investments in CDs and stuff like that, it was a little bit, more safe and secure, then they would have lost all that money. But guess what? The good thing is when you're young, you start putting money in your 20s, and your 30s, and your 40s, you can go ahead and take a few more risks. Why? Tell me why. Why can you take it? You have a little cushion. And what's your cushion? Time. Well, you have. Okay, so you have a cushion. You have your personal emergency fund, but your investments have time to rebound from some of the ups and downs. If you look at the market goes like this all the time. So whenever it comes down, you got to have time to ride that out. In your 60s and 70s, you don't have that time, but when you're in your 30s and 40s, you do. Cool. So you're out shopping for a financial institution. I'm going to make this slide brief. Do your research. Find somebody who takes care of military folks. Okay? I'm not trying to lead you towards anything. What I'm trying to say is that there's a lot of places out there that give advantages to military because you PCS, because you deploy, because you have challenging, a lot of frequent TDYs and things like that. You may need the ability to bank mobile or go even global. Cool? Okay. Do your shopping around. So to start now, and in these books on page 6, it starts with a budget. I would encourage you to use this book. The captain and I were talking. He says this looks more like a portfolio, a financial plan that you would keep for your life. My hope is that one of these days you're in your 50s and 60s, you open this thing up and you go, I've arrived at my destination. Okay, but if you will jot down your budget. And you guys don't have to necessarily do this as freshmen, okay? I realize that as freshmen it's a little bit different. With juniors and seniors, you guys need to start looking at what your budget is. What's your stipend? How much is your paycheck going to be once you guys graduate and you're out there, actually making a paycheck? Makes sense? So with the budget, what do you know? You know what's coming in. You know what's going out. And a lot of people don't set a budget. And the reason why they don't set a budget is that they don't really want to know what's coming in, and going out. They just want to reach in their pocket. If they got $10, they want to go ahead and buy a chocolate bar, or a pack of cigarettes, and a soda pop, or something like that. $10 will cover it, okay? So what happens the next day when they need $10 for gas? They don't have money in their pocket, so how do they get the gas? Credit card, right? They reach in the back pocket and pull out the credit card, boom. Credit card pays for it, not going to worry about it, I'll pay the bill when it gets here. When the bill gets here, can they pay it? No, so they pay the minimum, then they use more. They pay the minimum, they use more. Because they don't have a budget, they don't know how much money is coming in, how much money is going out, and how much money they can afford to spend for a chocolate bar, a soda pop, and a pack of cigarettes. Cool? Or a pizza. So create a budget, pay yourself first. It's important whenever you make a paycheck for you to do something nice for yourself, okay? But after you pay yourself first, save regularly. Anything you do regularly, what happens if you do something regular? I'm going to pick on you right now. You do something regular, what happens? Becomes a habit, okay? So you start putting some money away on a regular basis. You do it every paycheck or once a month, and it just becomes that much easier. So over the years, you're able to put more money. Now, if you put $100 a month away whenever you're a lieutenant, and then you get made captain and whatnot, you say, oh, $100 is easy. I'll put $200 away. And then after that becomes easy, you get promoted to major, and you say, okay, I can put a little bit more. I'll put 250, maybe 300, something. So this is something that actually somebody told me when I was in the Air Force. Every time you get promoted, you make money on your promotion. Well, first month you have to pay for a promotion part, but then the second month after that, then you start taking that money that is extra, because if you get used to living, if you just get used to spending everything, you really don't make any headway. But whenever you get promoted, you get a little bit extra money. Start putting a little bit extra into your investments, your TSPs and whatnot. Make sense? And then create an emergency fund. I cannot emphasize the value of emergency fund enough, because all those guys and gals that would walk into my office and they would say, Shirt, I got a problem. You know what was the look on their face? Were they happy? Hey, Shirt, I got a problem. No, they were like, dejected. Sure, I got a problem. I can't pay attention. Okay, I can't focus on my work. I can't focus on my kids, my family, all that stuff. I'm depressed. Not only are they depressed, these are people that we're actually having to really work with, maybe with clinics to try to help get them undepressed. But they didn't have emergency funds, because the person's got an emergency fund. They got $6,000, $8,000, $10,000 sitting in an account out there, a CD or some sort of a savings account out there. What they have is they have that peace of mind to know that if I have an auto accident, I don't have to worry about paying my deductible. If I have transmission go out of my car, or I have unexpected medical bills, or Junior has some unexpected school expenses or something like that, has an opportunity to go to Europe on a trip or something like that, I don't have to worry about where I'm going to come up with that money, or go around and ask family, stuff like that. So that less stress that I have in my life by being able to manage my expenses, my monthly expenses, improves my relationships at work, improves my job performance, it improves everything about me. Okay, it makes me a happier person, makes it easier for me and my wife to get along. And that's really, I'll tell you what, my wife is a rock star, and we do a good job now because of her, because she is a OSU grad, she's a CPA, she's done well in her life, okay, but she is good at helping me to manage the money, okay? That's a side note, okay? It's not in the slides. Dudes, if you are ladies, if you don't know how to manage money real well, find somebody who does, okay? Find somebody who can spend the rest of your life with that knows how to do that, because it'll make your life a lot easier. So create an emergency fund. We're able not to live paycheck to paycheck. We're able to buy what we need around the house and stuff like that, not really worry about stuff. And it doesn't have anything to do with me. That has to do with her, having a plan. She has a plan, she follows it, she sticks to it. We don't buy stuff we don't need. Makes sense? All right, so here's how you make money grow. You can see the slide there. If you start out at age 22 and you put $100 a month away and the money makes 10% over the lifetime, it'll be worth a little over $1 million. $100 a month is a $54,000 total investment, and it's worth over $1 million. And I'll show you how you get 10% interest here in just a second. The reason why that money grows so quickly like that is, or not quickly, but the reason why that money grows so much is the rule of 72. If you take the rule of 72, take the interest rate, and you plug it into 72 in the product there, 7.2 years, is how long it takes for money to double. This works if you're getting the interest, and it works when you're paying the interest, okay? So whenever you get a credit card that's got 18 or 21% interest rate, you just put that number into 22, 18, every 4 years. If you have a large balance every 4 years, that money's doubled, okay? So it takes a long time to get those credit cards paid off. If If you wait till you're 32, you see where you have to bump that investment up to $200 a month, and you still don't wind up with the same $1 million. Now you're at $750,000. Okay? If you wait till you're 42, you have to bump it up to $300 a month, and now you can only get to $400,000. Okay, so what the point of these slides is that if you start when you're 22, start when you're 23, 24 years old, you've got time for your money to grow. But if you wait till you're in your 30s, it's going to be hard for you to reach those financial goals, especially if $1 million is on your financial goal, right? And then if you wait till you're in your 40s, you can't get there. I mean, you'd have to save $700 or $800 a month every single month if you waited till you're 42. For 25 years, $800 a month, that's kind of tough, isn't it? All right, so let's just say you can't get there. All right. Credit's important. How many of y'all have a credit card already? Okay. I'm not asking, so I'm just curious, because those of you that already have a credit card know the importance of using that credit card and paying the balance of that credit card. Some of you may have family, like mom and dad, help co-sign to get it and whatnot. They've got a watchful eye. Got a niece, and she's in college down in Oklahoma City, and she has a credit card, and basically her mom and dad pay the credit card off each month. But they're helping her build her credit. Credit card is the quickest way to build your credit. It's the easiest way to build your credit. Because coming right straight out of college, your first duty station, the bank's not going to be really willing to loan you enough money to buy a home. Okay? So the easiest thing for you to do to establish some credit, to build a credit report, is to get a credit card. Okay, so whenever you apply for those credit cards, make sure you read the fine print. Okay? Every card has fine print. If you don't read that fine print, you're not going to know what goes into that. For instance, a 0% introductory rate isn't a 0% forever, is it? How long is it usually a 0%? Usually like 6 months, sometimes a year. And then sometimes they'll advertise, but then it goes to 12 or 14%. But what happens whenever you don't make a payment or you make one late? What happens if you let's just say you got a 12% interest rate and you don't make a payment? The fine print almost always tells you what happens if you fail to make a payment or payment on time. And then it always default to say the rate becomes 21% or 18% or something like that. So what you pay on those accounts, what happens whenever you go over the established balance on that account, all that stuff is incumbent on you. The bank does not require their underwriters to limit you. What they do is they put that responsibility on you. If you have a $500 limit, you go and you try to use that card, you go over your limit, and they're going to charge you for it. Cool? So you got to be careful. That's how the banks make their money. The banks make a lot of money off of people because they don't read the fine print. And let's just say, for instance, if you got an 18% interest rate and you pay the minimum balance, this is one of the reasons why they love you, is because if you pay that minimum balance of 18% on a $3,000 credit card, if you pay that minimum balance, it's going to take 116 months to pay it off. 116 months it takes to pay that $3,000 off, making the minimum payment. So you want to pay a lot more interest. The banks like that because you make the minimum payment, then you're cool with that. You're cool with your credit report, okay, if you make that minimum payment. But it costs you a lot of money. So the better thing to do is pay more than the minimum that's required, because if you, on this bottom line down here, if you pay $200 a month at 18% interest, you get it paid off in 18 months instead of 116. So it makes a big difference in what you pay. Here's a vehicle loan multiplier. Most auto loans are going to be, if you don't have any credit, they're going to be 6 to 10% interest. If you have really good credit, if you've used that credit card wisely while you were in college, and you get out of college, you want to buy that first car, and you have good credit score, your first car, you might get, the loan rates right now are like 1.5% to 2.5%. Okay, so you can get some pretty good rates on your auto loans. But the thing is, you got to do your math, because there's a lot of offers out there. The car dealers will give you offers like 0% interest or $6,000 cash back. And most people go, ooh yeah, 0% interest, I like that, that sounds good. But if you do the math, $6,000 cash back is almost always a better deal, because they give you $6,000 off the price of the car, and then whatever it is that you're financing. If you do the math, like here, over a 5-year term at 6%, $15,000 car, that's $2,400 worth of interest. Okay, so I just profited $3,600 on my transaction by going ahead and paying the interest and taking the discount. Makes sense? All right, so here's the key. Managing your debt, pay more than the minimum that's required. And I already showed you the importance of that. Keep enough credit open to where you can manage your business, but you know, Captain, I don't know if you guys find this or not, but you know, in life sometimes we go, it'd be nice to have an extra credit card. We don't need a whole lot of credit cards. I know that I've been a victim of this a lot in my past. You know, walk into Lowe's. Lowe's says, hey, we're giving an extra 20% off today if I have a Lowe's card. Okay, well, I'll sign up for that. Then you go to Sears. They do it at Sears. Then you go to, you know, you name the store, and every store has their own card. Bass Pro, Cabela's, all the places that I like going. They want, I see a smile up here. You like Cabela's? Bass Pro?
Oh, yes, sir.
You want to go there, you want to get some hunting gear, you want to get some fishing gear. But you go there and you use their card, now you have a line of credit that's open. And it's important not to have a whole lot of lines of credit that are open, because that hurts your debt to income ratio. And most banks look at those open credit cards as extended credit as opposed to zero balances. Why? Exactly, you got a possibility, right? So if I loan you $150,000 for a house today, and then you go out and you max out all your credit cards because you're maxed, you could actually portray a positive picture when your financial situation can be quite negative. Make sense? So because that possibility is out there. So another thing you can do to build your credit is use your debit card, not your credit card. You know, and that draws straight from your from your savings account or your checking account. Pay your bills on time. I mean, that's a no-brainer. Seek advice. There's always someone out there to help out. When you get to your first duty assignment, I know it's a ways away for you guys, but when you get to your first duty assignment, you go, man, I wish my airmen had the same briefing that I got when I was in ROTC. Good news. All you got to do is contact the local military affairs rep, because we're all volunteers for this process. And I do this for the Airman Leadership School down at Tinker. We're out here willing to do this for you and in your organization. All you got to do is just invite us in. We won't get you in trouble because we won't talk about USA departments. You guys heard about payday loans? You guys know what those are? They're very popular around Army installations. They're not as popular around Air Force installations, but they do exist. And these are basically loan sharks. And when we have an airman or a soldier who can't afford to pay attention, they go in there and they say, hey, I need $1,000. And the payday loan shark gives them $1,000. Says, okay, on payday, you come back and pay it back. On payday, are they better off than they were the day they went in there and got that $1,000? You think they still have that $1,000 sitting around? No. So what they do is they roll it over. They roll it over to go, oh, maybe next payday. Maybe next payday. Maybe next payday. And then all of a sudden, one day, the first sergeant gets a phone call and finds out that somebody's credit has tanked, that they don't qualify for a top secret or a secret security clearance anymore, that we need to pull them out of the mission and turn them into weeds and seeds. You know, so I mean, it's kind of frustrating because you got somebody who's a good airman, but because they get into financial trouble. So we have to help them out. When I say help them out, that doesn't mean we reach in our pocket and give them any money. We got to make sure that they're hooked up with the Airman Family Readiness Center, that they have people that that are willing to coach them on ways to get out of financial trouble. And oh, by the way, the Air Force Aid Society is out there to help provide some financial support to airmen that get into financial trouble. you know, with no interest loans and stuff like that. Building your credit reputation. One thing starts with your checking and savings account. If you write an overdraft, make sure you have overdraft protection on your checking account. Don't get used to writing overdraft checks, because overdraft checks are going to cost you money in the long run. If you have overdraft protection, you go, I'm not worried about it. Just keep in mind, every time you go over and they have to pull money from your savings account, it's going to cost you probably $10, $15, $20 to do that. So, again, if you didn't have the money on the check, but you had it in your savings account, just transfer it over in your checking account. Pay your bills on time, keep your credit card balances low, and review your credit report annually. And here's the 3 credit reporting bureaus: Equifax, Experian, TransUnion. They give you a free annual credit report. Each credit bureau will give you a free annual credit report, and then you know what they're telling others about you. Okay, essentially that's what you want to know. Here's what goes into your credit report. You see the white portion and the light blue portion there is payment history and debt. If you have a credit card, if you have a payment history on that credit card, you have 65% of the equation on your credit score covered. If you have your credit history for about 3 or 4 or 5 years, when you get it out to about 7 years, you've pretty much maxed out your length of credit history. So now you've got 80% of the puzzle covered. If you're not taking out a whole lot of credit cards or taking out a bunch of loans, then you should have a pretty high credit score. Okay, and you can do that with a credit card. And oh, by the way, I didn't mention this on a credit card. If you use a credit card and you pay the balance off in full every single month, what's your interest rate? Anybody know? 0. Got a 0 there from the junior class. They know. 0% interest. Okay, so if you use a card for gas and groceries as a convenience, and you pay it off in full at the end of the month, and you don't get carried away with it, 0% interest. And your credit score will look phenomenal one of these days, because you're going to have regular use and regular payment of that credit card. Cool. That's a good deal. All right, identity theft. And you guys know how it happens. Some of the stuff that you tweet out, some of the stuff that you do, in social media is really kind of risks your mission security. And that's why the military has to restrict sometimes what DoD members can do on social media. Worse than that is it lets people get into your business. Some of the things, the transactions you do online, just make sure that those are secure. But believe it or not, over 50% of the identity theft today still happens because people are diving in dumpster diving. Okay, they're going in after your trash. So whenever you get an envelope in the mail that says, any bank, USA, we want to give you a credit card, you get that, and you say, oh, I don't want that, flip it in the trash and whatnot. Every time you flip one of those in the trash and you throw that trash away, somebody has potentially got your information. Worse than that is the military members, when you PCS, every time you PCS, you change your address. When you change your address, you've got a chance that your mail is not going to get to you, that it's going to wind up in someone else's mailbox. Okay? Not as bad if you live on base, but if you live off base in a community that maybe it's a military, maybe it's somebody who's honorable, maybe it's not, and somebody gets your mail and they go, hey, I can fill out this credit report. This is Mike Moffett. All right, I'm going to go ahead and do this. Send it off. Credit card comes back and they hey, yeah, it's payday. So they go out, they spend money up, and it's because the mail forwarding system doesn't always work. So military members, not to mention the fact that your name is on DoD databases, that while I was in DC, 3 times laptops were stolen or lost or something like that, and the government had to scramble and protect everybody's identity. The Target thing that happened this last January, okay? These things happen. So make sure you have some sort of protection for identity theft. It's important. Protect yourself, but also go ahead and pay the few dollars a month that it costs to get some credit and identity theft protection. Cool? saving and investing. There's, we get out there and we start saving our money, and a lot of people will keep, you ever heard somebody say cash is king? I actually know some people say cash is king. I wouldn't put my money in a mutual fund or investment. Well, guess what? In a savings account, they're not going to make any money. They're going to make a half, maybe 1% on their money. It's low risk. Yeah, it's guaranteed, but it's not going to grow. Okay? So the key with saving and investing is having a good balance. You need to have some money in savings, some money in checking, some money in certificates of deposit. You need to have some low risk stuff, but you also need to, especially you guys being young, take a risk with some of your investments and go ahead and put them out there in some stuff that's going to help you grow your money. One thing, when you deploy this savings deposit program right here, that's a guarantee. It's a program. It's DOD approved, congressionally approved, DOD funded. And what it does basically is while you're deployed, you can take up to $10,000. You can put it in a savings account. It grows at 10% interest. Okay, and it's guaranteed 10%. And at the end of your deployment, you can keep it in there for another 3 months. So if you deploy for a year, you can make $1,000 off of a $10,000 income. Now guess what? If you have an emergency fund that has $10,000 in it, and you deploy, you can take your emergency fund and you say, hey, I want to go ahead and invest that in the savings deposit program and let it sit there for a year. But if you don't have any money, if you're not prepared for the deployment, you know you're not going to be able to just, say, oh, put $10,000 in if you don't have $10,000. Make sense? So that's kind of one of those things you want to plan for. Just know that it exists, and once you get commission, guys, once you guys get commission, be thinking probably what, 2 or 3 years after they get commission, they're going to be deployed. So you got a couple of years to build up that emergency fund. Cool? The higher risk stuff, stocks, bonds, real estate, how many of you guys play around with some investments in here? Just penny stocks and stuff like that. So, you know what? My recommendation is get good advice, okay? Be really careful what you're doing, because you can win, you can also lose. Just like going to the casino, you can go in there, put a bunch of money on blackjack table. You can win, you can lose. Same thing with your investments. So just be careful. Probably the most popular way to invest is mutual funds. Okay, because your IRAs, your 401ks, TSP, they all kind of follow the same sort of format. But mutual funds, they take all of our investments and pull them together. And let's say that Captain Randall, I'm going to use her as an example. She's a financial money manager for a fund. We all put our money into a fund, and she invests it for us, okay? And the better she does, the higher our investment goes. So we put more money in, more money. When she has more money, she can diversify more. She can do more things with our money. So if she's making our money grow, we're all happy with it. It's a mutual fund. And the way it happens is because she's putting it in. She knows about the stock market. She's the professional, and she's buying into a diversified group of funds. Okay, so she doesn't put it all in one company, because if she put it all in one company and that one company went bankrupt, let's just say she put all her money in Enron, and then Enron goes under, and then we're all like, man, oh, Captain Randall, you just blew our money. So she may have had some money in Enron, but when she saw the Enron thing getting ready to blow up, she transferred that money over to something else, because that diversification makes that fund strong. Make sense? Okay. So professionally managed. Main thing is that you understand how they work. And this is how you get 10% on your money. Let's say, just for instance, you put in $150 a month, and each share costs $10. That means you get 15 shares in January. If the price goes down, does that scare anybody? When the price of a mutual fund goes down? It's kind of scary, because I put in money, and now my investment's not working. But Dave Ramsey also says the only person who gets hurt on a roller coaster is the one who jumps off. In other words, if you're in that fund and you're putting your money into it, put 150 in February. When it went down, you got more shares. In March, you got 30 shares. You got a lot more shares. In April, it did come back up, because that fund's not going under. That fund's just got a dip, and it does that all the time. So In April, we get 21.4 shares. In May, we get back to that 15 shares. But look at our total. In May, if we'd have been getting 15 shares every month, that would be 75 shares at the end of the 5 months. But what do we have? We have 100 shares. So we got 25 shares worth of profit. 25 shares worth of profit at $10 a share. That's $250. We just made a 33% return on our investment. Now that's an example. Okay, it doesn't always happen that clean, and that cycle may take a full year to go down and back up. And there may be times when it goes up high. And if you're thinking about getting off the roller coaster, you say, this ride is complete, always make sure you get settled whenever it's high. Okay? But maybe it's high when I'm 52, and I say, I'm going to dial back the risk on some of my investments. I'm going to go ahead and sell now and put this into some stuff that's a little less risky. Makes sense? So that's just kind of how a mutual fund works. Just do your research, make sure you check out the objectives, the performance. Are they investing in precious metals or technology, things that make sense, okay? Because if you watch the economy, there's times when the stock market's up, what happens to precious metals, gold and silver, platinum? They go down. All right, when the market starts coming down, watch those precious metals start coming back up. Why? Because consumer confidence is not in the market. It then falls back on stuff that's actually has a value. Because you know what? Walmart stock may look real good, but at the end of the day, it's just a piece of paper. But gold, silver, you actually own something. All right? So a lot of times people will put a lot of confidence in owning gold and silver because I can take that and I can trade it for something. Okay, that piece of paper that Walmart stock's on, I can't trade it for nothing. Okay, I might be able to sell it if somebody won't buy it. Cool? Cool. All right. This is just a slide that shows you how the stock market rolls up and down over time. But you know what? There's a lot of people who made a lot of money in a flat economy. You just need to make sure you get the right advice because, you know, so if you say, flat economy, I don't want to take my chance, you're not going to make anything anyway. You're not going to lose anything, but you're not going to make it. All right? But if you go ahead and take the chance and you start saying, okay, my investments, I want to go ahead and get them out there. There's a lot of people who make money in a flat market. So. You guys heard of IRAs, thrift savings plan. You guys are going to be in the thrift savings plan. I would always recommend the first investment that you guys do is your thrift savings plan. Make sense? Okay, and when you get your check, that money's already gone out of your check. It's already gone into your thrift savings plan. And the TSP doesn't cost you a dime to manage that because the government does it for you for free. Okay? If you're in reserves or the Guard or something like that, and you're working for a civilian corporation, your civilian corporation probably has a 401k. The IRA is our way of saving additional money for our retirements. There's a traditional and a Roth. The traditional says that we'll save money on our taxes right now by putting some money back for the future. But guess what? We're going to have to pay taxes on that money eventually. We're going to have to pay taxes. When do you pay taxes on it? When you pull it out. Okay? With a Roth, when do you pay your taxes on a Roth? You pay them now. Okay? So the money that I put in is already post-tax. So money you put into a Roth IRA, it grows, and when you pull that money out, then you don't have to pay any taxes on it. Okay, so let me give you another piece of advice. When you deploy, if you deploy to a combat zone, you get what they call a combat zone tax exclusion. Okay? In a combat zone tax exclusion, they take all of your pay and they exclude it from taxes. So if you take any of that pay and you put it into a traditional IRA, you're going to apply a tax to money that is tax-free. Okay? So if you go, let me be crystal clear on this. If you go on a deployment and you're gone for a year or 6 months or whatever, any investments that you make with that money, put them in a Roth. Because you took tax-free money, and you put it in a Roth, it didn't get taxed anyway, and it won't ever be taxed if you put it in a Roth. Make sense? Okay, so just a piece of advice. Cool? Cool. Oh, by the way, the TSP has the Roth option on it now. I was looking at these funds the other day. The C fund and the L fund have both performed very, very well over the last 6 to 8 years. But some of those will help you just kind of like mark time. 2, 3, 4%. Some of them maybe 5% growth. So there's a place to go whenever you're in the last 5 years of your tour. Here's your options for cashing out the TSP. The key is just start early. When you guys get in, start investing early, start investing often. You can see here that there's big growth off of small investments, but it all hinges off of starting early. Risk management. There's some things you can do to save some money on your insurance. You can't change your age. You can't. So until you're 25, you're going to pay extra. You can't change your gender. So the bottom line is if you want to save money on your insurance, the best way is to be a better driver and to use some, actually understand how insurance works, because a lot of people, they're not well enough insured in some areas, and then, how many of you guys want a high deductible? Does anybody in here really want a high deductible? I do. Captain does. I want a high deductible. Why? Why do I want a high deductible? What are you juniors up there doing?
Because you're paying lower monthly.
You pay a lower monthly premium. But if I take more of the risk now, I pay lower premium. And so, so I definitely want a higher deductible. And so that's one of the ways you can save some money. You guys know how auto insurance works. You know what the 25-50-25 means. State law requires you to have this, 25-50-25. What is it?
Liability.
That's liability, and it covers the first 25 is $25,000 coverage. If I have an accident with you, it's my fault. You got $25,000 worth of hospital bills covered by my insurance. If the two of you guys are in the car together, you got $50,000 to cover the two of you together. All right. If there's three of you in there, there's $50,000 to cover the three of you, or the four of you. If you guys are in a minivan, I heard you on a minivan. Okay. If you're in a minivan, you got 12 people in there with you, and I injure every one of you, still only have $50,000 of coverage. That's the max that I can get for any people in that other car. Okay? State law requires us to have this coverage, but whenever you're out there in the Air Force and you're making a paycheck and you start putting some money into some investments and whatnot, you need more coverage, okay? Because if you have an accident, oh, by the way, the last number, that 25, counts for property damage for the car that you hit. The car or cars that maybe you caused damage to, okay? So you need a higher coverage limit, and it's not a lot of extra money to pay for extra liability insurance. I'll just tell you that me, myself, because I own a home, I have investments, I have some things, stuff like that put back. So I have a $300,000 liability limit on my home and my auto. My auto looks like this. And then over that, I have $1 million liability umbrella. Because I don't want somebody, if my son has an accident with somebody, I don't want to come and sue me for everything at work. All right? The way this works is this. If you have an accident with somebody, you want them to sue your insurance company, not you. The way they sue your insurance company is if your insurance company limits are worth more than you are. If you're worth more than your insurance limits, then they're going to sue you. If Kevin Durant had this insurance right there and he hit me broadside in the car, ain't no way I'd deal with his insurance company. I'd deal with them. I'd sue him for everything he's worth because he's been playing so crappy. But no, I really wouldn't know. I say, Kevin, it's all right. Man, I'll just go ahead and fund this out of my pocket. The reality is that we just need to make sure that you're covered on your liability, because this is the most important piece of your auto insurance. The type of vehicle. If you drive a fancy car, I wanted a sky blue Corvette whenever I graduated from high school. I could afford the car, but I couldn't afford the insurance. So just be careful what kind of car you buy. or motorcycle. Where you live is important. The Air Force is going to tell you where to live, but wherever you live, those, if you're on base, typically it's cheaper to insure you on base than it is off base. Driving record is the number one thing to control your costs. If you have a clean driving record, you can see a 23-year-old single male. Oh, by the way, don't get married so your insurance will go down, but if you're thinking about getting married and you're a 23-year-old male, guess what? When you get married, your rate goes down. Women have cheaper insurance rates than men do typically because they're, when they do have an accident, it doesn't do as much damage because they're not out aggressively driving. So when you get married, more responsibility. When you have kids, again, more responsibility. Your rate goes down. But if you have tickets, accidents, or DUI or something like that, it could make you uninsured. Here's the other part, the deductibles. You can see there, a lot of people love that $0 comprehensive deductible because they don't have to pay anything out of their pocket. But guess what? They pay a lot out of their pocket. It's called a premium. They pay everything out of their pocket. Okay? So if you've never had an auto accident that was your fault, you'd be much better off having a $500 or $1,000 deductible as opposed to having a small one. Go home and ask your dad what his deductible is. I bet you he's, like mine's $1,000. So, renter's insurance covers your personal property. It also covers your liability, you know, when you're walking around. Life insurance, very important. SGLI is going to have to cover. But whenever you get to the middle of your career, you've got family and kids and stuff like that, you need to look at outside life insurance. You want to make sure you have a policy that takes care of military members, something that doesn't have like a war clause in it. When the 9/11, when the Twin Towers came down on 9/11, most of the insurance policies in that building did not pay because the insurers had war exclusions, and that was an act of war. So the policies didn't pay after those people were paying. All they did was they paid back their premiums. That's all.